Welcome back to the channel. My name is Jorin. I'm a quality investor, and today we're going to be doing some portfolio reviews. So as many of you have probably noticed, Liberation Day by Donald Trump kicked in, announced all kinds of tariffs. Fears of recession started to kick in and everybody's portfolio just tanked. The only thing that got liberated is my portfolio. And today I want to review others' portfolios. So I sent out a message on my Substack. If you do want to join my Substack and you want to be part of a next portfolio review, you can just join my Substack with the first link in the bio. You can subscribe for free and you can join the chat with like-minded investors if you're interested. I also have a paid version. You can try it out for 7 days, no card required, free trial, completely free. If you don't like it, you can just leave it. So I asked in the chat for them to send me their portfolios with a short story on who they are, what they're trying to achieve, and what their portfolio is made of. And I got some pretty bizarre portfolios. So we're going to go over them in great detail and see if their portfolio has the same fate as mine has and got liberated by Donald Trump. So without taking much more of your time, let's just get into the video. So the first portfolio, anonymous number one. I did mention in the chat with my request that you can stay anonymous. 3 people wanted to remain anonymous. They did give me their story and they did give me, their portfolio. And I have to look at my notes because I have to see their story. So the first one, his goal is to invest in high quality growth companies that have shown consistent performance and potential for future growth. His primary goal is growth at a reasonable price, he said. His name, anonymous. He's 36 years old, long-term growth investor focused on the technology sectors with established leaders. My portfolio consists of dominant companies with a strong growth potential. Okay, so let's look at this portfolio. I like it. It's automatic data processing, Google, MasterCard, Meta, Mercado Libre, some Salesforce. I'm personally not a big fan of Salesforce, if I must say so myself. I think it's a great company, high insider ownership. It's founder-led and tend to outperform other companies. So maybe that's the case with Salesforce. I'm not really familiar with their product. They do have some solid growth. I do know that, but I'm just not a big fan of Salesforce. But a lot of people have Salesforce in their portfolio. It's a wonderful company, solid growth. They're in the custom management systems. So it's crucial for companies. High switching costs, which really benefits Salesforce. So overall, it's a good company, a high quality company. I love that it's founder led. So that's a good pick. Mercado Libre. I love Mercado Libre. As many of you know who have been following me on Substack, I do portfolio updates every month there. Mercado Libre, I bought it at around $1,700 a share. Wonderful business. People call it the Amazon of Latin America. I kind of do agree. It's an absolute powerhouse. I both have Mercado Libre and Amazon, so I'm reaping the benefits of both the growth right there. He also has Broadcom. I mean, it's a good company. I like it. Management, not a big fan of. The last time I checked management, they didn't get that much positive reviews. And the same goes for Alta. Alta, it's a retailer. It's okay. Their growth is predominantly having to come from expansion. They're going to expand to Mexico via some partnership they're doing. And most of the growth has now having to come from Mexico. So as soon as I heard that news, I was like, I'm just going to get out of Alta. Having your growth dependent primarily on the partnership you're going to do in Mexico. It's kind of tricky to me. Yes, Mexico, it's a huge thumb. There's great opportunities there. But for me, it was just, and I wasn't sure. And if I'm not sure, I'm not going to invest in personally. So I had Alta in my portfolio as well. It was like roughly 6% of my portfolio, but I switched it out. And the reviews that I read on Alta's management, there's a lot of Reddit communities on Alta, and they're not really that positive on the business. So he also has a cash position of $500. Good, have some cash on hand. I also have some cash on hand. I think I right now have, 2% of my portfolio in cash. I'm going to make some more deposits, rise that 2% to 4%. Because if the market keeps crashing, I'm just going to keep buying. Meta, I also recently added Meta. Wonderful business, founder-led. Zuckerberg still has, I thought it was 13% of the outstanding shares are in his ownership. Wonderful business. still growing. Last year they grew, I think on average year over year, something like 20%. It was bizarre. Wonderful company. Automatic data processing, again, high switching costs. It's really sticky business model. I love it. I have been checking it out, but it's not really my cup of tea, not in my circle of competence. Google, I also have Google. Google for me is around 9 to 10-ish%. MasterCard, yeah, I have Visa. If you have Visa, you basically have a MasterCard. If you have a MasterCard, you basically have a Visa. It's pretty much the same. I'm liking the allocation as well. Pretty hefty in Meta. He told me that I think around 60% of this was pure gains. He bought in Meta really at a very early stage, so that's good for him. But like these 3.4, 5.4, that's okay. But a 3.4 position in your portfolio, it's not going to have significant impact. So I wouldn't recommend going anything below 5%, 5.4. My lowest allocation is, I think, 6.3%, because I don't see any added value of having such small allocations. But again, if it fits your style of investing, you do you. So we're going to go to the next portfolio on our list is Boris. So let's see here. His goal is to invest in companies with strong growth potential, especially in tech and innovation. His name is Boris, 29 years old, focused on emerging technologies and innovation. My portfolio reflects my belief in the future of tech, software, and digital platforms. Yeah, I would agree there. I do see some names that, just one name. It's actually HIMS. I'm not a big fan of HIMS. It has a lot of growth on the high growth outlook. It's an overall good business. Management doesn't have much skin in the game, which is kind of a downside. Well, you cannot always have companies with management with heaps of skins in the game. I also have a few companies where management almost has no skin in the game. Again, we see Google here. I think everybody in this list, almost everybody has Google. I think Google is the go-to investment for almost everyone. I have it as well. Booking Holding. I love Booking Holding. It's just always expensive. Even now, I think it's trading at a more reasonable price. I think it's trading somewhere between 26 PE and the next 12 months, I think it's 24. I'm not really sure. Very good business, high margins, management executing perfectly. I love it. It's a high quality compounder. I love this. MasterCard. Every investor has either MasterCard or Visa. Everyone does. It's just they're running a duopoly. It's just insane. If you don't have it, you're actually missing out on something. It's almost always a good time to buy either MasterCard or Visa. Amazon, I'm a big fan of Amazon. We almost have the same allocation. I have 16.3%, 16.4-ish in Amazon. Wonderful business. Again, AWS, it's a hyper growth monster. So I do agree here. The allocation looks fine, a little hefty in Google. If I compare it to like the bottom 25%, 25, 30-ish. Because here we see Paycom, very sticky software, very sticky, high switching costs, the retention of the customers, it's good. So I like this kind of business, like payrolls, HR, everything in that type of industry. It has a very high retention rate because making the shift from one platform to the other, it's a tough switch to do. You have to train your employees again on a new software, and it's just too much of an hassle. So people tend to stick with these kinds of businesses. That's why I really love those type of businesses. Netflix, yeah, you pretty much can't go wrong there. Netflix, it's a good company. They're investing heavily in making new shows. Although my personal issue is with Netflix is there's better options like Hulu, I think, is one. HBO, I use a lot of HBO. I think they have a more variety in their offering. Disney Plus, I love using that one. Netflix, I did used to use it a lot actually, because some time ago I thought it was the only streaming service that was available and had okay movies and series. But then I discovered Disney, Hulu, HBO, and some HBO classics are better than Netflix classics. So it's but nevertheless, that's just personal preference. It's a good business, solid margins. Management is, yeah, it's okay, can't complain. Shopify, Canadian business. Shopify is a Canadian business. Yeah, I haven't looked into Shopify enough to actually give my honest opinion on this business. I do like their business model. So they create a whole website for you. They manage the back end and the front end, but you can edit the front end to your own liking. And you just have to apply some apps or plugins to make it a little bit more efficient. Like you forgot to check out all those extra add-on plugins. But Shopify just basically gives you the site. You can upload your product. You can link it with your own systems, and you can just start pushing out your site, and Shopify will handle almost 90% of everything you have to do. So I love the business model. Again, very sticky. If you sign up with Shopify and you want to switch to another website, you have to transfer everything. You have to set up the whole new website. You have to link the payments towards there again. And it's just a big hassle. So again, a very sticky product. I do like it. And I think a lot of big names in the industry actually use Shopify. I recently posted a 10-minute deep dive, 10-minute breakdown, so a very digestible format, investment case-ish on Nu. It's a wonderful business. Management has significant skin in the game. Margins solid. The growth, it's exponential. It's just bizarre the amount of growth they're experiencing. Their MPLs, it's perfect. Their efficiency ratio, it's also perfect. Nothing really worrisome about the business. Why I'm personally not investing in it, it's a bank. I don't like banks that much. I don't invest in that type of finance industry. Banks are... A lot of people love banks because they're usually protected by the government. If something happens with the bank, the government steps in and they just get help. And yes, that creates some barrier of safety, and they're protected by some barrier of regulations from competitors, for instance. But I just don't like banks. It's just not my thing. And HIMS, yeah, I don't like HIMS. It's a good business. Don't get me wrong. It's a wonderful business. They're really playing in on a strong secular trend, and that is men's and women's health. It's a very strong secular trend. They had a huge spike due to their GLP semaglutide hype we have seen not too long ago. I think even their share price went from $30 to I think somewhere $70 or something. Since then, dropped again back to 30. It was just a buying frenzy and then a selling frenzy. But again, it's not a sector I would invest in. HIMS hasn't proven to me yet that it is a high quality compounder. So although I do like the business, I wouldn't personally invest in it. But you said you focus on innovation, then I do understand that you're investing in HIMS and in Nu and in Shopify, Google. That's innovation, so I do understand this. But again, like I said with the previous portfolio, the allocation to me is a little bit 2.6%. If HIMS doubles, you won't notice that much, and HIMS could double. We never know. Low market cap, they're still growing, so they could easily double. If it doubles and your allocation is still 2.6, you're not gonna notice that much of a gain. So like you have here 21.5, 19, almost 17, 15.3, 8.9, 7.6. These are good allocations. 6.7, again, very good. But in this case, if you really want to hold on to HIMS and Nu, I would maybe, what should I do? It really depends on your average buy price of the stock. Maybe trim a little bit of Google and a little bit of Booking to just scale these positions so that the least allocation is roughly 5%-ish. I always say to myself, I don't want any positions smaller than like 5%, because if those double, for instance, you actually do notice a significant increase in your portfolio. But again, if you're comfortable with this kind of allocation, perfectly fine. It's a wonderful portfolio. Looking at the fact that you said you like innovation, you do. I can see it. It's a wonderful portfolio. So the next one we go to Patrick. Let's see. Ooh, I'm already liking this one. He says, I'm focusing on the most innovative and high growth companies, primarily in the tech industry. Short introduction is, I am Patrick, 34 years old, passionate about tech and believes in the market shaping power of industry giants. I love finding companies that are pushing the envelope on innovation. Google innovative, Nvidia innovative, Amazon. I mean, I wouldn't call it the peak of innovation, to be honest. ASML, most definitely cutting edge technology. It's just bizarre. A complete monopoly on the EUV. And I think also basically a duopoly on the DUV. And Meli, yeah, they're growing, but it's retail. But they do have Mercado Pega. I forgot the name for a second. So you could argue there's some innovation there. So yeah, okay, maybe Meli, yeah. Okay, so yeah, I would say that this aligns with your description. This is a wonderful portfolio. NVIDIA, he mentioned that he recently added NVIDIA at around $94. So that's good. He just recently added this. Google, wonderful. Meli, yeah, this allocation also, you're very heavy into Amazon and you just can't go wrong there. It's AWS alone. If Amazon was just solely AWS, even then with 33.1% allocation, I think you'll do very well. This portfolio is definitely going to outperform in my opinion. ASML, although a bit cyclical, I do own ASML as well, by the way. Although it's a bit cyclical, I love the business. It's running a monopoly. Management, Christopher Fouquet, he knows what he's talking about. I've listened to a lot of interviews that Christophe Fouquet. It's a Frenchman. I'm actually going to a, how do you say it in English? Yeah, it's like an open house. So you can just walk in and you get guided and you get told about everything, what's not confidential, of course, of ASML. So I'm looking forward to that. Meli, yeah, we already touched on Meli a couple of times. Wonderful business, good growth, loving the fintech arm of Mercado Libre. Google, again, innovation, a monopoly, yes, for sure. So you're good there as well. And NVIDIA, perfect. A small cash position of $683. Did you mention? No, he did not mention any plans with the cash. But overall, this is a very good portfolio. Very concentrated. You got 5 positions here. That's good. I personally have right now 9 positions, and I think that's my sweet spot. He mentioned that this is his sweet spot, and perfectly fine. It's high quality growth companies. Absolute compounders. You can't go wrong here. So next on the list we have Sarah. Let's see right here. Her goal is to invest in high growth companies across a range of sectors with a global perspective. The name is Sarah, 26 years old, just got into stocks and the fundamental process. Most of these stocks were lucky picks and I was able to buy when the price was low. Let's see. Salesforce, yeah, we already touched up on that. Wonderful business. I do think 25% of the Salesforce, almost 26 is a bit hefty. Salesforce has a pretty high beta, so I think your portfolio is pretty volatile as well. Again, we see a MasterCard at 17%. Perfect. It's a wonderful business. You can't go wrong there. PayPal, PayPal, it's a good business. They're expanding with partnerships. They did a partnership with Adyen. They're doing a lot of stuff right now. But I don't like the business. It is just, it hasn't been doing as I expected it to do, especially in the industry it is in, the digital wallets, the fintech, pretty much. They should be doing better, in my opinion. And their returns have reflected this. The returns have been not really something to write home about. Ulta, we touched on this. Wonderful business, but their growth is really dependent on their expanding operations in Mexico. And again, it's a retailer, so but as long as you're comfortable with it. TMDX, Transmedic, I think they're the only one who are FDA approved on their lung, heart, and one other machine, which is good. That creates a monopoly for them because they're the only ones with the machines. I'm just not too familiar with the business, so I can't really make a verdict on it. I think they're not even profitable yet, as far as I've seen. Are they? Let's just do a quick cosmetic. Yeah, so as we can see here, they're not even profitable yet. Well, December 24, they're profitable. Okay. I just, their margins are improving. So they went from 12.3 in 2016 to a almost 70% margin in 21. And now they're down to roughly a 60% margin. So it's just all over the board. Their operating margin, it's looking horrendous. Yes, it is a fairly new company. 1998. Well, I thought it was a little younger than that actually. But yeah, it's margins are all over the place. I don't know how the future is gonna look like for this. It's a strong secular trend, that for sure. I think there's a growing demand for these type of machines for lung and hearts. And the organ care systems, yeah, it's a good sector, but again, I don't know. So Transmedic overall, it's an okay business. It's 7.8% for you. I personally, if you like it, keep it for sure. I did think she mentioned she got it, she bought it when it started to rise again in price. So there was a lot of expansion, a lot of buying up, and she's actually down a lot on this position. So it was probably even a bigger position than it is right now. That is painful. That's really painful, especially with a business like Transmedic. It's barely profitable. I don't know what the growth is going to look like for this business. I don't know what the margins are going to look like, what the earnings are going to look like. Yeah, it's tough. But then you have Visa at 6.4%. You have Visa, MasterCard. So if Transmedic does take a hit, Visa and MasterCard will take much of the hit. They're wonderful companies. And even Salesforce, I think, will take a big chunk of the hit. And then you have 2.10K in cash. So you have a bigger cash position than your position in Visa and Transmedic. You did not mention any plans with the cash. Well, I would maybe, if you want to scale, you could maybe look into scaling Visa a bit, or just look for a new position altogether. Maybe add some more diversification here, because we can see here payments, customer management, healthcare, retail. I mean, yeah, it's diversification. It's all right. So the next one is Kev. His goal is to invest in market leaders. So let's look at his portfolio. Oh, wow. Ooh. His introduction, his name is Kev, 21 years old. He loves emerging companies in the tech and software industry. Alibaba at 56.5%. That is bizarre. More than half of your portfolio in Alibaba. I mean, if you're really convinced in Alibaba, I mean, sure, you should go for it. The thing that's holding me back, one, China regulations, laws, it's just too unpredictable for me. I think even years ago, Jack Ma even went missing or something. He came back later, but I was just like, wait, what? Because I thought he was critiquing the leadership of China, and suddenly he went missing, and then he came back. Yeah, I don't want leaders or management of companies that I'm investing in to suddenly just disappear and come back. I think that was with Jack Ma. If not, correct me in the comments, of course. Then after that, we get BUM, Brookfield Asset Management, wonderful company. I have looked in it a couple of times. Good management, a good business model, nothing really to complain about. Amazon, we touched upon it, wonderful business. Pinduoduo, to be very honest, I've looked into this company once, maybe twice, because I don't invest in China, so I almost never look into Chinese companies. Alibaba, of course, it's a big name, so I had to check it out. Pinduoduo, never checked it out, but I know it's in China. I know it's retail. Apple, I don't know why people still own Apple these days. Apple's growth is and their innovation in new products. I have so many arguments with people in regards to Apple. I think Apple is not innovating enough. I don't think Apple is what it used to be. And a lot of people say, yeah, but new iPhones, new chips. I mean, yeah, but you're still getting the same product, just a little better. Some argue that is innovation. Some argue that it's not innovation. And I argue that really isn't innovation. And moreover, Apple, their revenue is, I think in the future, primarily coming from their services segment. Because their wearables, their iPad, it's all not growing. They're not making sales. I think the iPhones do still make sales, but it's very cyclical, because then you have your iPhone release, and a couple of years you don't have a new iPhone release, and then you have a new iPhone release, and then you get a lot of sales again. So I think iPhones, yeah, they do still make sales, but it's just having to wait on the new iPhone the whole time to see a jump in sales for Apple again. And their revenue from their services segment is just taking over. So Apple might just transform in a services business. Who knows? Those services do have very high margins, so that is something that Apple has going for it. But No, I don't understand why people would still invest in Apple. He didn't mention that he's a growth investor. So if you're a growth investor and you have Apple, I doubt you would get much growth out of it. But again, personal preference. Tesla, wonderful company. Although China sales are declining, they're kind of being stuck for the last 1-2 years on an annual sales of, I think it was 1.7 million cars. Let's just take a look at it because I do want to make sure I say the right thing. Yeah, so as we can see here, overall revenue was going up still, although a bit cyclical here, but it just took a nosedive here. We are seeing some increases again, but China sales have been very tough for Tesla. So that is something. It's a headwind for the business, but then again, their energy generation and storage and their service that is growing. Let's look at the changes here. There we go. Because that revenue segment is growing extremely fast. So let's just look at the revenue change. So as you can see here, although a bit all over the place, it's growing massively. 99.7, 52.4, 112.9. Their services and other revenues, 24.6, 21.3, 28.8, 31.5. So this is growing at insane rates. But again, it's a smaller segment. So the law of large numbers is not kicking in yet in these segments. So then you can realize fast growth. And Tesla has the scalability to do this. So that's something they have going for them. So yes, I like Tesla. But also with Elon Musk getting into the political aspect of everything right now, they are facing a lot of headwinds. So yeah, it's a good business, but it's just too much headwinds right now for my liking. And again, it's in the automotive. Margins come under fire a lot of the times, and it's just something I wouldn't personally invest in. But again, you said you like it. All power to you. And then you have cash, 5.28K. It's 3.1%, and he had not mentioned what he's going to do with his cash. Overall, good portfolio, but this Baba position, I mean, I hope most of it is gains. If not, I personally wouldn't be so heavy into Alibaba, more than half of your portfolio. If Alibaba faces some sort of headwind that's going to impact either the fundamentals or sentiment around the business, you are going to take some pretty hefty kick in the balls, actually. So that's my point of view on this. Then we go to anonymous number 2. Let's see right here. Anonymous number 2 said, invest in companies that are proven performers with the long-term growth potential. I'm 24 years old, focus on steady growth with a solid foundation. Since the Max 7 always performs well, I just bought those. Yeah, you just have the Max 7. Tesla at 32%. Okay, we already covered Tesla. Not a big fan. I think also this allocation to Tesla is just way too big. Microsoft software, can't really go wrong there. Sticky software. Basically running monopolies. Meta, I would increase Meta. I would just scale down Tesla, increase Meta. It's a better business. Nvidia, just scale this to like 15% if you want to keep it a bigger position, and just start scaling these smaller ones right here. And maybe just get rid of Apple. Apple, who likes Apple? Oh, a lot of people actually like Apple. I don't like Apple. Overall, it's a good portfolio, but again, I would scale down Tesla. And scale up Meta, Nvidia, Google, Amazon. Amazon right now is just dirt cheap. Well, not dirt cheap, but you can expect a good annual return rate if you just scale your Amazon position, lower the average cost of those shares. I think you'll do better right there than having such a large portion in Tesla. Then we go to anonymous number 3. And he says, I think I have the wrong one. No, I have the right one right here. I love semiconductors. My goal is to outperform the S&P, the MSCI World, and the NASDAQ. He is 25 years old. He wants to be part of the next big thing without much research. Portfolio is filled with semiconductors because he sees this as the future in regards to AI. And he also saw some Reddit posts on these companies, and he thinks he has a diamond hand. I mean, yeah, you have a lot of cash, so I would maybe look for some diversification in some other industries. Nvidia chips, chips. Yeah, you're heavy in the chips, semiconductors, 100%. It's a very promising sector, especially with the new rise of AI. It's perfect, but I would look for some diversification. Although, yes, you have different companies, but they're all in the most cyclical industry, one of the most cyclical industry we have. So I would just look for something else in that case, just some diversification. But besides that, NVIDIA, ASML, TSMC, excellent companies. Broadcom, yeah, it's a good company. But with this cash, that's 17.34K, look to diversify the portfolio a bit more. I think you'll be better off diversifying the portfolio a bit. And then next we have Mika. And she says, my goal is just to have a high growth portfolio. I'm Mika, 30 years old. I bought stocks that fit the current economic setting. Defense, yeah, I can see that. Yeah. And some emerging markets. I tend to switch based on the now active trends. All right. So yeah, defense, Lockheed Martin, Boeing, for sure. I'm not a big fan of Boeing with all the issues they're having with all their planes and stuff. It's just management. Their compensation is just absurd. Even when Boeing is performing some of the worst years, the compensation of management is just through the roof. Having that type of compensation, the incentive for them to perform how the shareholders want them to perform, it's not there. They're very compensation driven on short-term things, and they have a huge base salary. It's just bizarre. So I'm not a big fan of Boeing because management is just awful. Lockheed Martin, quality company. I like it. You said you focus on now active trends with defense. Lockheed Martin is then a good play. I like Lockheed Martin. Good company. Nu, we already covered Nu. Nu is a wonderful company. Not much to say about that. Uber is a wonderful business. It's an excellent business. There's a lot of growth amongst the bears with Tesla, with their FSD and autonomous vehicles. But I think Uber is setting itself up perfectly already. It has partnerships with a lot of companies. It has a partnership with Waymo, for instance. And in one region, somewhere in America, you can only order a Waymo through the Uber app. So that partnership is perfect. Uber has their platform to reach out to the consumers. Waymo goes on their platform and gives them the ride. It's just a win-win. And I think something crazy like Tesla even getting on the Uber platform to promote their autonomous driving. I think that would be a better case scenario than just Tesla fully taking over. Because Uber has an all-in-one app and it's super powerful. It's bizarre how powerful it is. Creating something this from scratch is possible, but Uber has the data. Uber has the scalability right now. So for Tesla to do something like this, they could, but it would just take a lot of time. And then you have to see if it works out, how Tesla wants it to work out. Then besides that, you have Visa at 6.3%. Again, high quality company. I'm liking it. And then you have a small cash position of 1.46K. Again, this is a good portfolio. Uber, 44.3%. I'm thinking this is primarily gains. I'm hoping. I would scale Uber down a bit to create some more diversification because it's almost half of your portfolio. Going half on one stock is pretty, it's intense. I wouldn't be able to sleep that peacefully at night if I have almost 50% in one stock. That is, that would keep me awake some nights. But overall, good portfolio. I like it. Nothing to complain about. All right. So we have seen a lot of portfolios. I think most of them are actually pretty good portfolios. I do not agree with like the Uber on 44.3% of your portfolio and the Alibaba on was 55% of your portfolio. If it fits your style of investing, you do you. Everybody has their own style. Everybody wants to approach investing in their own way. I would just recommend a little bit diversification to just, sleep better at night. With that all being said, the program I'm using is FameChat. You can use it for free for 2 weeks, no card required. You can use my affiliate link in the description. If you do sign up and you do take a subscription, I just get a very small cut of the cake. It does not get more expensive for you. Again, you can try it out completely for free without giving up your card information for 2 weeks. Use it, see how well it works. It's a wonderful program. I use it for everything, for earning calls, looking at the slides, of course, the fundamentals. I use it to monitor my own portfolio. I use it like daily for everything. All said and done, I would also recommend you to click the Substack link in the description. We're right now a community of 1.2k of like-minded investors who focus on high-quality companies. If you're interested, you can click the link in the description. You can sign up for free. You can also start a 7-day free trial, no card required, again, to get access to my premium content. And there I give my portfolio updates. Those are monthly with my buys and sells. Detailed investment cases, also very digestible short investment cases that don't take longer than 10 minutes to read, and a lot more is published on Substack. So with that being said, I hope you enjoyed the video. If you did, subscribe to the channel, like the video, drop a comment, and I hope to see you in the next. Cheers.